Welcome, deep divers. We're about to plunge into a truly compelling and, at times, pretty gut-wrenching story. Before we jump in, make sure you've liked and subscribed to the Stock Analytics AI YouTube channel. And hey, remember, for just $4.99 a month, members like you get priority deep dives on the tickers you want us to cover. So today we're putting America's largest residential solar company, Sunrun Inc., under the microscope. Tickers RUN.
RUN, yeah. And believe me, it was running.
Straight off a cliff, right? Back on June 17th, 2025. What a day.
Absolutely historic volatility. The stock plunged, what, over 40%?
Yep, wiped out nearly $1 billion in market value, just like that. So the central question for us today is, well, it's profound. Is this the final tragic chapter for a debt-laden growth story?
Yeah.
Or is it maybe a classic opportunity? Buy a dominant market leader when there's blood in the streets?
It's definitely a high-stakes binary wager, really only suitable for the most risk-tolerant investor, I'd say. And just to give you a little sneak peek at where we land, the current price, around $5.52, it actually sits near the high end of our estimated intrinsic value range.
Which, for educational purposes, we've put between, what was it?
Between $2.84 and $5.68 per share. So, yeah, tight range, and it's bumping up against the top.
Okay, so our mission today is clear. We're going to unpack Sunrun's business model. We'll evaluate its management, really scrutinize its financial health, and weigh those considerable risks against its potential long-term value, all anchored to that critical day, June 17th, 2025. All right, let's begin with Chapter 1, Business Analysis. At its core, Sunrun isn't just, selling solar panels. They pioneered this solar-as-a-service model way back in 2007. They sell power.
Right. It's a key distinction.
Think about it. You get a complete solar and maybe even a battery system installed on your roof.
Yeah.
Little to no money down.
Yeah, that's the hook.
Exactly. In exchange, you sign a long contract, 25 years, to buy power at a predictable rate, often lower than your utility. Sunrun owns it, monitors it, maintains it all.
It's a brilliant way to acquire customers, no doubt. I mean, they have over 1 million subscribers now.
Huge number. But here's the catch, the double-edged sword. This model is extremely capital intensive.
Oh, massively. They pay for everything up front, the panels, the installation, everything. Then they collect revenue over, a quarter of a century.
Which creates this massive perpetual need for external capital, mostly debt and something called tax equity.
And that right there, that's its central vulnerability. That's what got laid bare on June 17th.
So that capital intensity really defines their whole financial structure.
Absolutely. Their main revenue stream, customer agreements and incentives, that comes from those recurring monthly payments. Leases, power purchase agreements, PPAs.
Right, the long-term contracts.
Exactly. Think of them almost like bonds. They generate, or were generating, about $1.6 billion in annual recurring revenue as of FY 2024. Then you've got secondary revenue from, direct solar system sales for people who want to own, and this emerging but strategically vital source from grid services.
The battery aggregation thing.
Precisely, where they aggregate their home batteries like Blightbox to help utilities manage grid demand. It's a really innovative approach, potentially high margin too.
And their products, they reflect this comprehensive approach. It's not just panels, it's end-to-end service. Design, permits, installation, monitoring, maintenance.
The whole package. And that Brightbox battery storage is crucial now.
More than just backup power, right?
Oh yeah. It's about storing cheap daytime solar power to use during expensive evening peak hours. Smart savings for the homeowner.
But the really innovative part, I think, is the virtual power plants, the VPPs.
Totally agree. By digitally connecting thousands of these Brightbox batteries, Sunrun can basically offer grid stabilization services during stress periods.
Like a power plant, but virtual.
Exactly. It's a new high-margin revenue stream. And their VPP capacity, by June 2025, it had already surpassed 650 megawatts. That's significant scale.
What's fascinating here is just their sheer dominance. They are by far the nation's leading residential solar and battery storage provider.
No question. Over 1 million customers, 22 states, D.C., Puerto Rico. It's a huge footprint.
And the market share numbers are pretty staggering. Q1 2025, they captured, an estimated 19% of new residential solar installs?
19%. And for new battery storage installations, it was 45%. Almost half the market.
Wow. That leadership in storage is clearly a key strategic asset, sets them apart.
Definitely.
So their value proposition is multi-layered. For homeowners, clean, reliable power, little or no upfront cost, predictable rates, energy independence. hassle-free, basically.
And for the grid, for society, it's decarbonization, it's grid reliability, it's a cleaner alternative to, say, dirty peaker plants.
But the industry itself, it's facing some complex dynamics right now.
Yeah, near term, definitely headwinds. We saw the market contract 13% year over year in Q1 2025.
Mostly high interest rates, economic uncertainty.
That's the main driver. But the long-term tailwinds, they are powerful. Rising utility rates, climate change awareness.
And just the massive new electricity demand coming from EVs, AI data centers.
Exactly. That creates huge long-term demand for residential solar. And the storage revolution is key here. Sunrun's storage attachment rate just soared, didn't it?
Yeah, from like 15% to 69% in about a year. That tells you where the future is heading. Solar plus storage.
No doubt.
Now, competition. This market is intensely competitive, highly fragmented.
Oh, yeah. You've got big names like SunPower, Tesla, component guys like Enphase and Solar.
Plus thousands of local installers, right? And indirect competition from utilities themselves.
And then there was the Vivint Solar acquisition back in 2020. $3.2 billion, all stock deal.
Big move, absorbing the #2 player. A bet on overwhelming scale.
They aimed for $90 million in annual cost synergies. But you have to ask, did it really deliver financial benefits? Or did it just create a larger, more complex, maybe even more financially burdened organization, especially given their persistent unprofitability?
Good question. And that brings us to the regulatory environment, which is arguably the most critical factor.
Absolutely critical. Their business model is just fundamentally dependent on government policy.
Like the 30% federal investment tax credit, the ITC.
That's the financial linchpin. And the proposed legislation to slash or eliminate it, that's what triggered the June 17th collapse. It's an existential threat, plain and simple.
And then at the state level, you've got net energy metering policies, NEM.
Also vital. Less favorable NEM rules, like the recent changes in California, they severely damage the economics for companies like Sunrun.
Yet despite these threats, there are still pretty significant barriers to entry for new players. A moat, if you will.
There is. Think about the extreme capital intensity we talked about. You need billions in funding, deep relationships with banks, and tax equity investors.
Not easy to replicate.
Not at all. And Sunrun's scale gives them purchasing power, plus access to asset-backed securitization.
Right. Bundling those long-term contracts to get cheaper financing.
Exactly. Cheaper than smaller rivals can get. And just the operational complexity managing everything across 22 states, it's immense.
So that moat is pretty formidable.
It is. Brand strength, they're #1, the oldest. Cost advantages in procurement and capital. Network effects, especially with the VPPs, each new battery makes the network more valuable.
And those high switching costs, those 20-25-year contracts really lock customers in.
Creates an incredibly sticky base. And their most unique asset, that portfolio. Over 1 million existing customer contracts. They call it contracted net earning assets.
That's the discounted value of future payments they expect.
Precisely. Management estimates it at $2.6 billion, or 11.36 per share. That figure is a core piece of any bull case for the stock.
Okay, really interesting stuff on the business model. Now let's turn our attention to the leadership team steering this rather complex ship. Let's move to Chapter 2, Management Evaluation. We've got Mary Powell, an energy industry veteran as CEO since 2021, and the co-founders, Lynn Jurek and Ed Fenster, are still involved on the board.
Right. And this team, they're not exactly new to adversity. Remember the short seller attack from Muddy Waters back in 2022?
I do. They responded forcefully, and the stock actually rallied after that.
Yeah. So Mary Powell, she's actively engaging the media right now in this current crisis, trying to frame the legislative threat as, a blow to consumers, to energy independence.
Trying to get a reasonable glide path instead of a sudden rug pull, as you put it.
That seems to be the goal. Looking at their long-term track record, though, it's been relentless execution of a growth-first strategy. Think Vivint, think hitting 1 million customers.
But often at the expense of profitability, right, resulting in this highly leveraged company.
Exactly. And this crisis really puts that growth-first, profit-later approach to the ultimate test.
What about communication and transparency?
Well, they follow standard public company practices, earnings calls, SEC filings, the usual. But there is a concern.
The non-GAAP metric.
Yeah, their heavy reliance on complex non-GAAP metrics like subscriber value or net earning assets. These tend to paint a much more optimistic picture than the frankly, bleak GAAP reality.
GAAP being the standard accounting rules,
Right.
showing substantial net losses, negative cash flow.
Right. So investors really need to be skeptical and dig into those adjustments.
And there's also that disconnect with customer complaints. I've seen reports.
There is a significant volume on independent review sites. Things like misleading information during the sale, unexpected bill increases, poor post-installation service.
That's not just bad PR.
No, it's a real operational and financial risk. It could potentially undermine the value of those long-term contracts if customers become disgruntled.
Okay, what about capital allocation? How are they using their money? Or rather, the money they raise.
Well, the single-minded focus has been growth, funded almost entirely by external capital, as we've said.
Primarily for creation costs.
Exactly. The all-in upfront expense to acquire and install a system, that's the engine of growth, but it's also the source of that massive, persistent cash burn.
And the Vivint deal, again. Cemented market leadership, yes. But did it create more complexity and burden than actual value? Especially since profitability didn't follow.
It's a very fair question. And it was funded with high-valued stock at the time, diluting existing shareholders.
And for anyone hoping for dividends or buybacks.
Forget it. Not happening. This is a high-growth, cash-consuming company. Any excess cash they do generate, their priority is paying down recourse corporate debt.
Debt the company itself is directly liable for.
Right. They paid down about $214 million over the last 4 quarters, which is a prudent defensive move, trying to increase their resilience.
But the overall picture from return on invested capital, ROIC, that's a pretty.
No, it's grim. Trailing 12-month ROIC is deeply negative, like negative 16.94%. Consistently poor or negative returns.
So on a standard accounting basis, GAAP basis, the company is actually destroying value with every dollar it invests.
That's what the numbers say. The bull case absolutely hinges on the belief that those long-term contracts will eventually generate enough profit far down the line to turn this all around.
Wow, okay. Raises a huge question. What do the actual financials tell us about Sunrun's health right now? Let's turn to you for Chapter 3, Financial Analysis.
All right. Well, the market's perception, as we saw on June 17th, 2025, underwent a seismic shift. Market cap crashed from about $2.2 billion down to $1.3 billion at the close.
Nearly $1 billion just gone.
Evaporated.
Yeah.
It reflects a really severe reassessment of the company's viability. Looking at revenue trends, it's a story of explosive growth, yes, up through 2022, peaked around $2.3 billion.
But then it stalled and reversed.
Stalled and reversed. Declined in 2023 and 2024, down to about $2.04 billion, largely due to those higher interest rates hitting demand.
They had a bit of a rebound in Q1 25 then.
A modest one, yeah, about 10% year over year. But now this legislative threat just jeopardizes any kind of sustained recovery.
And the profit margins. Tell me about those.
It's a stark picture. Gross margin, TTM, 14.64%, so they make a modest profit on the core operations themselves.
Okay, that's something.
But then you factor in the heavy sales, marketing, G&A burden. Operating margin plunges to negative 24.56%, deeply negative.
But a bottom line, net margin.
Staggering. TTM negative 129.94%.
Wow, minus 130%.
Yeah. Corporate costs, and especially the cost of servicing their debt, are just completely overwhelming any operating profits. The bear case says these costs are structural, baked in. The bull case hopes scale and efficiency can eventually turn things positive. It's a big hope.
What about cash flow? Free cash flow generation.
Okay, this is critical. Sunrun doesn't generate free cash flow. It incinerates cash.
Incinerates. Strong word.
It fits. Massively negative SCF, and it worsened consistently. From litigious $1.29 billion in 2020 to negative $3.47 billion in 2024.
$3.5 billion burned in 1 year.
Yes. And it's crucial to distinguish this from management's own cash generation metric you might see in their presentations. That metric conveniently excludes billions in capital expenditures needed to acquire those assets in the first place.
So the real picture is relentless cash burn, completely unsustainable without constant external financing.
Exactly. Which brings us to financial stability.
Earnings consistency.
There isn't any. It's a chronic inability to translate revenue growth into bottom-line profitability. Consistent, deeply entrenched GAAP net losses, 4 of the last 5 years negative.
And the debt to equity ratio.
Extremely high leverage, somewhere between 4.7 to 1 and 5.2 to 1. Assets are financed primarily by debt, which just magnifies risk enormously. Huge pressure on cash flows to service that debt.
Any bright spots in stability?
Yeah.
Liquidity.
Well, the current ratio is 1.32. which looks adequate for short-term liquidity on the surface, but the quick ratio is just 0.99.
Just below 1, meaning
Meaning they rely on selling inventory to meet immediate obligations. Very little room for error if sales slow down or funding dries up.
and dividends.
No dividend, no history of one, no expectation of one anytime soon.
Okay, let's talk valuation. How is the market pricing this company now? PE ratio is useless, obviously.
Right, negative earnings. But price to sales, PS, collapsed after the crash, down to about 0.63 based on that $1.3 billion market cap and roughly $2.1 billion in TTM revenue.
0.63, what was it historically?
A mere fraction. It was over 10.0 back in the growth heyday of 2020. Shows you the extreme pessimism now baked in.
And intrinsic value. You mentioned the DCF approach is tricky.
Yeah, a standard discounted cash flow based on free cash flow is, well, functionally useless. Some models spit out deeply negative values per share, like negative $14.
Because the cash flow is so negative.
Exactly. So a more logical approach here is an asset-based valuation. Focus on that existing portfolio of customer contracts, the contracted net earning assets.
Management's $11.36 enters per share figure.
Right. But given the huge political and financial risks, you have to apply a significant discount, a margin of safety. Applying a 50% to 75% discount to management's number gives us that educational intrinsic value range of $2.84 to $5.68 per share.
And that implicitly assigns zero value to future growth.
Essentially, yes. In this environment, with the existential threat hanging over them, valuing future growth is incredibly speculative. This asset-based approach is a more sober way to look at it.
So what does this all mean for how the market is actually reacting day to day? Let's dive into Chapter 4. Market sentiment. Analysts' price targets must be all over the place.
Fractured is a good word, and sharply negative overall. We've seen a recent wave of downgrades, Jefferies, BMO, KeyBank, all cutting targets down to the $4, $5 range.
So the average target around $11. That's basically obsolete now.
Completely obsolete, almost double the current price. And the dispersion is huge. Targets range from $4 all the way up to $21. Just shows extreme uncertainty. Nobody really knows.
And the news flow around June 17th. That was the catalyst.
Absolutely catastrophic for sentiment. Headlines screaming, Sunrun plunges 36.2% as solar tax credits face cuts. Solar stocks dive as Senate bill keeps cuts. The narrative became, their business model is on the chopping block. That fuels panic selling.
Okay, market indicators. What about short interest?
Exceptionally high, between 28% and 29% of the float.
Wow, nearly a third of the available shares are betting against it.
It's a tangible embodiment of the bear case, a huge institutional bet that the combination of political risk, a broken model, and fatal debt levels will sink the company. It creates constant selling pressure, constant volatility.
But that also creates massive short squeeze potential, right?
Absolutely. If any positive news hits, say, favorable amendments to that legislation, shorts would be forced to buy back shares to cover their positions, that could trigger a violent parabolic rally.
Makes it a paradise for short-term traders, maybe.
Paradise for traders, nightmare for long-term investors trying to sleep at night.
And technically, the price chart.
Catastrophic breakdown on June 17th, sliced right through its 50-day moving average, around $7.94 then, and the 200-day, around $10.94. On historic volume. It's an unequivocally bearish technical signature, no way around that.
Okay, if we connect this to the bigger picture, it's fascinating to see who actually owns this company despite all this turmoil.
Wow.
Let's explore Chapter 5, ownership structure.
Yeah, it's quite revealing. An extremely high percentage, about 92%, is held by institutional investors. So the smart money historically bought into the growth story.
BlackRock, Vanguard are the biggest holders.
They are. BlackRock with about 18.4%, Vanguard 10.5%, but there's a divergence happening now among those institutions.
So selling, some buying.
Exactly. Some are trimming positions, maybe taking risk off the table, but others, like Greenvale Capital, reportedly added 12%. Dimensional Fund Advisors added 50% recently. It's a classic battleground stock. Big money placing opposing bets.
What about insiders, management founders?
They hold around 3.4% to 3.7%. There's routine selling, which you often see for diversification or tax reasons, but there's one key bullish signal here.
Oh, the founder purchase.
Yes. Co-founder Ed Fenster made an open market purchase of 150,000 shares back in February 2025. Average price was $6.80.
So over $1 million invested personally at a price higher than it is now.
Exactly. That's a powerful contrarian signal. A multi-million-dollar vote of confidence from someone with the absolute deepest knowledge of the company. It's a critical anchor for any bull case.
Interesting. And this ownership structure being so concentrated among a few large institutions, that affects trading.
It does. It can reduce daily liquidity, make the share price more susceptible to big swings based on the decisions of just a few major players. If one big fund decides to sell, it can have an outsized impact.
Okay, this raises an important question then. Boiling it all down, what are the key risks and opportunities that truly define Sunrun's future? Let's move to Chapter 6, Risk Assessment. Maybe a SWOT analysis helps here. Strengths, weaknesses, opportunities, threats. Let's start with strengths. Market leadership is obvious, right? Hashtag one U.S. residential solar and storage. Strong brand recognition.
Definitely. And their scale gives them those cost of capital advantages through securitization we talked about. Plus that large contracted customer base, over 1 million sticky contracts.
And their leadership in storage and VPPs. That 45% market share in new storage installs, being a major VPP operator, that's a real strength.
Agreed. Now, weaknesses. Chronic unprofitability and that massive cash burn are glaring. Consistent gap losses, billions in negative FCF.
And the extreme leverage, high debt to equity, makes them vulnerable.
Hugely vulnerable and completely dependent on capital markets. They constantly need new debt and tax equity financing. If that dries up,
Big trouble. And that inconsistent customer service reputation.
it's a weakness. Those negative reviews could impact contract renewals or even long-term contract viability if issues aren't addressed.
Okay, opportunities. The residential market is still largely untapped, right? U.S. solar penetration is only around 5%.
Massive runway for growth there. Plus, the whole home and EV electrification trend means growing demand for electricity, which solar can help meet.
And the explosive growth in energy storage itself. The shift to solar plus storage is a huge opportunity for the leader.
Absolutely. And the potential to monetize those virtual power plants through high-margin grid services is a significant, relatively new opportunity.
All right, now the big one, threats. Adverse regulatory and political change has to be top of the list.
Without a doubt, it's the existential threat. Loss of federal tax credits, unfavorable state NEM policies. These could cripple the business model.
Intense competition from that fragmented market isn't going away either.
No. And then macroeconomic factors, especially high interest rates. We've seen the damage they can do.
High rates are like a poison pill for this kind of capital-intensive business.
Perfect description. They directly increase Sunrun's cost of capital, squeezing non-existent margins, and they make solar loans more expensive for customers, suppressing demand. It's a major ongoing threat.
And geopolitical factors, like those tariffs imposed in 2025.
Yeah, the U.S. tariffs on Southeast Asian solar components, where Sunrun gets a lot of its panels, that's a direct hit to their bottom line.
Management acknowledged that adds significant cost per system.
They did. $1,000 to $3,000 per system in 2025, they estimated. That's a significant squeeze on margins and cash flow they really can't afford right now.
Wow. So many moving parts, so much risk.
It's fascinating how it all comes together, isn't it? Which leads us perfectly into our final thoughts. Let's turn to Chapter 7. Conclusion. Synthesizing all this. The bull case for Sunrun. It's a high-risk, high-reward bet on survival. Plain and simple.
Buying a market leader at potentially maximum pessimism.
Exactly. Believing the stock might be trading at or even below the discounted value of those existing 1 million-plus customer contracts. Remember our discounted range? $2.84 to $5.68 versus management's $11.36.
And the bulls would emphasize Sunrun's undisputed #1 leadership, their dominance in storage, that strategic lead in VPPs.
Right. It's basically a wager that these political fears are overblown, or that management can navigate them, mitigate the damage somehow, that the company survives to capitalize on those powerful long-term tailwinds, electrification, rising energy demand.
And the most tangible piece of evidence for the polls.
Has to be founder Ed Fenster's significant multi-million-dollar open market stock purchase at $6.80 per share. That's a powerful vote of confidence from someone who knows the business inside out.
Okay. Now the bear case. It seems pretty simple and powerful, too.
It is, and
Yeah.
very plausible. The company is potentially on the brink of failure.
Business model, never gap profitable, existentially threatened by subsidy removal.
Appalling financial condition, massive losses, relentless cash burn, extreme debt.
Complete dependence on external capital markets, access to which could just evaporate,
Yeah,
triggering a liquidity crisis.
that's the nightmare scenario. And that massive 28-29% short interest. That's the market's clear vote on this outcome. Significant institutional belief that bankruptcy is a real foreseeable possibility.
It really is a classic Wall Street standoff. Optimists seeing deep value in the rubble, pessimists smelling blood in the water.
Perfectly put. So, restating our valuation summary. Standard DCF is useless here. The asset-based valuation focusing on existing contracts is the most appropriate approach, we think.
Leading to our educational intrinsic value estimate, $2.84 to $5.68 per share, applying that significant margin of safety.
Correct.
And the current share price, $5.52 as of June 17, 2025. That sits right near the high end of our estimated range.
It does, which tells us the market has priced in enormous risk, but maybe not a complete guaranteed doomsday scenario just yet. There's still some hope reflected in that price, however faint.
So an investment in Sunrun today is truly a high-stakes binary wager. It hinges on political outcomes and the company's ability to navigate what looks like a severe liquidity crisis.
Absolutely. If the bear case plays out, the stock is likely worth zero or close to it. But if management somehow pulls off a lobbying success, secures a financing they need, this current price could look like a generational buying opportunity in hindsight.
Extremely skewed risk-reward then.
Totally skewed. Suitable only for the most risk-tolerant investor, someone with really strong conviction in a favorable political resolution and operational turnaround. Not for the faint of heart.
Wow. That was a truly deep dive into the fascinating and, frankly, precarious world of Sunrun. Thank you for joining us today. And hey, don't forget to like and subscribe to the Stock Analytics AI YouTube channel. Remember, for just $4.99 a month, members get priority deep dives on the tickers you suggest.
And please, everyone, remember, this analysis was generated by an AI system. It's for educational purposes only and should absolutely not be considered financial advice.
That's right. We strongly urge you to conduct your own thorough research or consult a qualified financial advisor before making any investment decisions based on this.
Please do.
So here's a final provocative thought to leave you with. Given what we've uncovered about Sunrun's deep dependency on policy, how might a company built on this solar-as-a-service model innovate to truly become self-sufficient, regardless of government incentives? Is that even possible? Something to think about. Thanks for joining us for this deep dive. We hope it's given you a shortcut to being well informed.